Forced to work from home by your employer? Laid off or feeling depressed at home? Do you want to make money working from anywhere? We'll show you how to do it from your couch. It's time for another episode of the Work From Home Show. Coming to you from their homes in Austin, Texas and Tampa, Florida, here are your hosts, Adam and Naresh.
Welcome back to the Work From Home Show. I'm Naresh Vissa with Adam Schrader, and we have with us Adam Fayed with us on the line. He is a well-known, internationally recognized entrepreneur, financial expert, the founder of global online financial advisory firm. The website is adamfayed.com, F-A-Y-E-D, if you want to check it out and check out his work. But he's coming on the show today to talk about personal finance and how people working from home, how people at home can focus more on their retirement, cutting taxes, investing from home, maybe managing or starting a business from home. So Adam Fayed, welcome to the Work From Home Show.
No worries, and thanks for having me on. It's a pleasure.
Yeah, and this is going to be a little bit different because, Adam Fayed, you're going to be repurposing this interview on your show. You have a popular YouTube channel and podcast as well, so you're going to be taking this episode and posting it there. So we're going to do it a little bit different. This is going to be more of like a roundtable discussion between you, Adam Schrader, my co-host, and me to just kind of talk about these different topics that I laid out. So let's first start the discussion, Adam Fayed. And how about you tell us some ways people can invest and set up retirement accounts when they transition off of their W-2 and become maybe an independent contractor or their own business owner. And I bring this up because right now in the United States, I'm not sure how it is worldwide. You can provide some insight there because we have quite a lot of worldwide, international, global listenership. But in the United States, most people are saving for their retirement through their employer. It's some kind of employer-employee 401k account. So again, what's your advice? What are your tips for setting up retirement accounts when people transition off of that employer? Here in the United States, we call it W-2, and they become independent contractors or business owners.
Sure. Well, first of all, before I kind of answer fully, I would say that, the United States, at least onshore United States, people living in the United States, is one of the few markets I currently don't service in terms of I don't have local clients in the US. That's not because I don't want them. It's just because I'm sure, as you guys know, with the whole IRS kind of legal kind of side, SEC, it's one of the most regulated markets now in the world, the United States.
Yeah,
so I do, just a little bit of advice. So I do have overseas American clients, but for American people living in America, or indeed non-Americans living in America, expats, I kind of refer on. But just to kind of talk about some of the basics, what's interesting is any surveys that have been done have actually found that sometimes what you invest in terms of low fees and indeed what kind of mechanisms you invest in, for example, do you invest in index funds or what you actually invest in per se, can be more important than just the tax benefits. Because a lot of people in the US, they talk about things like IRAs and those kind of, as you said, solo IRAs and whatever. And of course, tax benefits are huge and it's something that people should do. But a lot of studies have actually compared and contrasted. For example, somebody who invests in like a low fee account through Vanguard without the kind of full tax benefits and compared that to a very tax efficient account, which is maybe quite expensive for a lot of actively managed mutual funds. And what they found is the slightly less tax efficient vehicle actually won long term compared to just focusing on the tax angle. So I'm not saying don't focus on the tax angle, but bear in mind the key things for individual investors are things like to be diversified, to be long-term, to really stay calm during moments like 2008 and March of this year when the markets were the bloodbath, pretty much, right? Those are the keys, actually, rather than a lot of people get really confused by all the mechanisms. Should I go for this IRA? Should I go for this account? Whatever. keeping it simple, being long-term, low-cost, really having essentially balls of steel when markets go down. Those are the key things. But I think for most people, when they go off the employer routes, the best thing they can do is just go to some kind of low-cost provider that will accept, these kind of solo self-invested accounts, so the likes of Vanguard, Betterment, or whatever, and index their accounts as much as possible. So have, for example, an S&P 500 fund, maybe government bonds, maybe a worldwide index. If emotionally they can't invest for themselves, they should use an advisor for the emotional support, almost like going to the gym. Not everyone needs a personal trainer, but let's face it, you're more likely to do it if you've got someone telling you to do something, just one more rep, right? It's kind of motivational. So I would say keep it simple and don't make it complex. I mean, Richard Branson had a great quote when he said, complexity beats simplicity. And anyone can make something complex. I think that's really true of investing. Simple strategies will actually beat complex strategies long term, but people forget that.
So in the US, people just talk about, index because you can't beat the market most of the time. Does that hold worldwide, or whenever you go outside the US and start investing, are the index funds not good there?
It does hold worldwide. I would just say one small caveat to that. Probably beating the market in the US is even more difficult than internationally, and there's a reason for that. That in the 1950s, 1960s, or those kind of decades, Warren Buffett and all those kind of people, they easily beat the market in those decades because they were competing against the teacher and the milkman and whatever. Whereas these days, 90% of the market is institutional investors, hedge funds, banks, blah, blah, blah. Individual investors are a much smaller percentage of the market. So at the end of the day, if there's a really undervalued opportunity in the US, it's very unlikely that all those machines, all those institutions are not going to see the same opportunity, right?
Yeah, you're playing against the big boys now.
You are, yeah. And when it comes to the small caps, emerging markets, there's a slightly better chance you'll beat the market, but it's not that high. So say, for example, beating the FTSE 100 in the UK, it's a little bit easier than the S&P 500, but not that much easier. Likewise, to beat the emerging market index compared to, say, the S&P 500, it is a bit easier. But bear in mind, it's still not very easy, and it's still, markets aren't stupid. They're not always efficient, but they're not stupid either. And as soon as you go to emerging markets, small caps, it might be a bit easier to beat the index, but you take a lot of risk there as well. So there's nothing wrong with taking minority positions there. If somebody wants to index 80, 90%, take 10 or 20%, have a few stock picks, whatever, it's probably not going to hurt them. They're probably not going to beat the market long term, but it's not going to be a disaster. Right, but if they start to put 60% of their pension in one stock, that's when you start to get problems. Because studies show, for example, people are more likely to put in to Amazon stock if they live near an Amazon warehouse, or if they support a certain sports team, they might be more likely to invest in that stock. Familiarity bias. We're more reassured by what's familiar. So I would say indexing the lion's share is fine, actually. But yeah, to answer your question, it's not easy anywhere now to beat the market, but the US is actually the hardest of the hardest, I think, now.
Well, you brought up some, what I call, a work from home investment advisor, which is Betterment or Wealthfront. I personally have tried Wealthfront just for fun. Somebody invited me. I think they got like $10 for inviting me, and I got like $10 for accepting it. And I actually haven't even checked my account. Maybe I should log in while we're here. I've had that account for, I want to say, 3.5 years now. And my guess is it's up quite a bit. But these kind of doing robo advisors, that's really what they are, robo advisors. I'm a huge fan of them because in general, I think our listeners know this. I think Adam Schrader knows this. I'm very pro technology, and anything that I can have a computer take care of for me instead of a human, I just trust a lot more. When it comes to autonomous vehicles, for example, I'm going to love them because one major issue right now is the whole texting and driving. Huge issue around the world. And another issue that's been going on forever is drinking and driving or being tired while driving. Well, the autonomous vehicle doesn't need to worry about. You don't need to worry about that. It doesn't get tired. It doesn't drink while driving. It just kind of goes. And in the case of robo-advisors, Adam and I have worked. We actually met while I was an intern for him at a financial management company that just completely scammed its investors, got shut down by the SEC, barred its advisors from, of their licenses.
We were not advisors.
We were not. We were not.
Let's get that out there.
I was just an intern. But the point that I'm making here is a computer can't do that. A computer can't, scam you or lie to you about your family and, what's best for your family. And it's just more honest. So I'm a huge fan of these robo-advisors. They've got these really intricate algorithms that go way beyond any of our heads. They tap into the best kind of PhDs in the world. And I just sleep better at night now. Like I said, I haven't checked my account in 3.5 years. I'm going to open it up right now. But I just feel better knowing that my money is safe under a computer.
Mm-hmm. Well, it's interesting you said that, though. I mean, have you guys kind of spoke to a lot of friends who have been with robo-advisors, and have they got good results on average? Or what has been your experience with these kind of companies?
Well, I'll say this. It's still a very new concept. The idea of digitizing anything is still relatively new. And the whole work from home movement, I think people are a lot of the older generation has realized, Amazon, I can just order stuff on Amazon. I can just order my groceries from and now Amazon has a grocery service, and you have Instacart, which is another prop. So people are understanding during this pandemic, during these lockdowns, that, I don't have to go out anymore and meet with a financial advisor. I don't have to go out and go to the bank branch to open up a savings account. I don't have to go to the grocery store anymore. I don't have to go to a restaurant and dine in anymore. I can just order it. Everything's literally on my phone, including the financial advising, the money management. It's an app. You download it, boom, it's on your phone. So when you ask, what are your friends doing? It hasn't caught on yet, but I think we're going to be living in a very different time 2 years from now, where these already, the brokerage Robinhood now they have a Robinhood index, because Robinhood is an app where you can trade, buy and sell stock free of charge. And
didn't they have a scandal recently, or was that somebody?
They've had I wouldn't call it a scandal, but their servers went down multiple times over the past since March, pretty much since the stock market has been very volatile over the last 4 or 5 months, and it's because of the amount of traffic and usage that they've had. It's not because they have bad IT people or bad tech people. Well, that could be a part of it too. They weren't prepared. But all this volatility has led to insane amounts of trading in illiquid stocks like Hertz, which, by the way, Hertz filed for bankruptcy and their stock should have gone to zero, but it was Robinhood that propped it up. I think it was 3,000%. Like it went from 50 cents to $5 in a matter of 3 days. But anyway, that's now the go-to. Now all these other Robinhood's competitors, like Schwab and Ameritrade and E-Trade, they've had to adapt and say, hey, you know what? We got to take this app stuff seriously. We've got to make it easy for people to buy and sell stock from an app. And we've got to cut our commissions from what they were charging, $9.95, $4.95. They went ahead, not all of them, but many of them went ahead and cut the commissions. Now it's $0 to make trades. I know I have Schwab for my retirement. $0 to make trades only because of Robinhood. So it is making these fintech companies are making a huge dent in the market, in individual stocks, in business models within the industry. And so, yeah, I do think Wealthfront and Betterment are at the forefront of this robo-advising. And given how unhealthy it is to just constantly be looking at your phone and, stocks and staying up at night, checking futures, just put it in a robo-advisor. Put in a robo-advisor and check 3.5 years later, just like I'm about to do.
So, Adam, how do you compete with robo-advisors?
Well,
and with
it's
the
an
whole
interesting.
indexing thing?
Yeah, I mean, it's an interesting kind of, question you bring up about the robo-advisors, DIY investing, and so on, because your question kind of links onto that, and that's that, like I was saying at the start of the show, that when it comes to investors, actually the biggest indication of returns are things like how long they invest, what they invested, and so on. But a lot of evidence out there shows that basically, I'll give you some like statistics. The people who perform best in investing, including DIY accounts, are dead people. And you might say, well, how's that possible? How do dead people outperform the living? And the reason is simple. Dead people don't have emotions, right? Dead people don't panic during 2008. And of course, if they don't have a beneficiary form and no one knows they're dead, let's say they don't have many friends, of course, the account's going to keep going and no one knows they're dead for about 5 or 10 years. But the point is, there is a serious point to this, and that's that actually the biggest reasons for investors failing are emotions, right? So the average DIY investor only gets about 4 or 5% a year, even if the index is getting 9 or 10%. So the issue with robo-advisory isn't the actual technology itself. I've wrote many kind of reviews on my website about betterment and so on. It's more how people are using them. So we saw that in March. The sensible people did what you're doing. They said, look, I'm not going to look at this for 3 or 4 years. But there was a hell of a lot of outflows as well. And I know Jack Bogle for Vanguard, he made this point in his book. I think it was called Speculation versus Investment. I forgot the exact name, but it's his last book he ever wrote. And basically he said that Vanguard, even though their whole principle is buy and hold, and they just kept saying that again and again and again, their biggest outflows were during the crisis, like 2008. Their biggest inflows were like 1999. So a lot of DIY investors, they kind of buy and sell, and they kind of go on this emotional roller coaster when the best thing to do is buy and hold every single month. So for me, in my business, I'm more focusing on kind of the higher level or mid to high level niche in like an expat market, and they often can't find portable solutions because, for example, let's say they're an expat living in China, they're British or Australian, whatever, then they're going to live in South Africa, then South America. Many, robo-advisors or DIY platforms won't actually take them. And number two, I think also there is that issue of trust, right? Because of the whole online presence. These days, people, as you were saying, Naresh, people don't want to go to a bank and see someone wearing a tie and that kind of formal kind of business structure. So for me, having such a big online presence and whatever, I think that's reassuring for clients, and they know I'm going to try to do the right thing for them. So I index a lot of clients' portfolio. So I actually think long-term robo-advisors and the technology will be used by the best financial advisors to actually save them time.
Yes.
So I think there's going to be a lot of advisors who are going to say, look, I'm going to charge you 1% fee, 0.1% platform fee. I'm going to use a lot of this technology like a gym instructor. I'm going to help you emotionally during the ups and downs, but I'm mainly going to index. And I think that there will be people, especially those in niches like expat niche or the very high end, who are going to want trustworthy human advice coupled with technology. And that's never actually, I think, going to go away. But I think the robo-advisory companies are going to get rid of those kind of, I wouldn't say low-level advisors, that sounds a bit negative, but those advisors who are not bringing any value added or are at the low end of the market. So in many developing countries, there's still like these huge sales forces for like tiny life insurance premium, like in the US or UK 50 years ago, when like the guy from Prudential would go around your house and kind of knock on doors and say blah, blah, blah. That still goes on, actually, in half of the world. That kind of thing still goes on. But I think a lot of those, that's going to end, or it's going to probably end. So I think advisors are going to have to raise their game. They're going to have to think about the value added. They're going to have to be educational as well and say, well, look, this is why investors fail, and I can help you with that behavior gap.
Yeah, I got a couple of follow-ups for you. First off, I'm not saying that technology is going to replace the human population. So I'm not saying, I think you bring up a good point that it's what technology is going to do is make the human population better. So I don't think the financial advisor or the money manager is going to become extinct. I think the technology is going to aid them in doing their jobs. And the same goes for any other profession. So if you think about radiology, we interviewed a radiologist as one of our first guests on this on this podcast. And the technology is going to help the radiologists perform better, do their job better, more efficiently, so they can take on more clients. And yes, like you said, the kind of bottom barrel, maybe even the people in the middle of the pack, they're at risk, because if they can't perform, if they can't adapt to the technology and deliver the results and have high performance, then they're not going to have jobs available, because the people who did adapt and who did who have just better performance. We live in a meritocracy, at least here in the United States and in most developed nations that have Robinhood and Wealthfront and Betterment. So the best of the best are going to come out on top, and those who don't perform, they're not. And so my question for you, you said that you wrote some reviews of Betterment and Wealthfront on your site. What were those reviews?
Well, basically what I said in a nutshell is that the technology itself, it's new, it is a bit untested, but there's nothing wrong with these companies, and not just these kind of American companies, but also some of the other companies. I did make a few caveats to that, though, and that included the fact that for non-Americans, this is a bit of a technical point, and to be honest with you, it's not a big risk. But what I do say to people is, for non-Americans to invest in a US brokerage, they should think twice. And that's not just Betterment, that's also Interactive Brokers and whatever, because there's always a small chance that you're going to get tied up in the whole kind of spider's web of US tax complexity. So, for example, withholding taxes and death taxes, yes, technically speaking, if you do a W-2 Ben form, it should be okay for non-Americans and you shouldn't have to pay tax to the US government. But there has been some people who got caught up in that. So I would say some of the non-US kind of robo-advisors are actually better if you want to go down the robo-advisory route for non-Americans. But for Americans, including Americans living overseas, these companies are actually pretty good, especially if you're at that kind of level where you can't find human advisors who can do a good job for a decent price, right? Because if you've got $500,000, you can find human advisors who are trustworthy, who have got good online reviews, who are charging a decent price, who can maybe emotionally help you. You know, it's not just about, as I said, returns, it's about investor behavior. But let's say you've got $30,000 as an American. I mean, frankly, how many advisors do you know who could do a good job in the local market, charging reasonable rates of return, reasonable fees for $30,000? It's probably not going to happen, right? Well, it's going to be very hard.
They're not going to be interested in your business.
No, because also there's a lot of regulation about how to charge in the US as well, right? So, maybe 40 years ago, when there could be upfront payments, they would have been interested, but not as much anymore. So I think the lower end of the market and also lower middle, I think the robo-advisors are going to do great. But I think as you get higher and higher and people's kind of niches get more complicated, like let's say they're an expat or I don't know, they've got a foreign spouse. It could be any kind of complexity. That's where the human working in tandem with the technology can offer value added if they're kind of sensible about it. But my reviews are relatively positive about those kind of robo-advisors. The only major negative, apart from that small thing about the US tax angle for non-Americans, is that robo-advisors don't automatically get rid of what's called the behavior gap. So robo-advisors came into the market saying, look, we know there's all these people who can't get serviced by the human advisors, and DIY investors, we know they don't perform that well because of what we're talking about. People get greedy or they get fearful. So what we're saying is buy and hold, don't look at your account. Our technology can do this and this and this. The problem is, though, during March, a lot of those robo-advisors actually lost a lot of client money. People panicked, right? Because people are people. And of course, in these robo-advisory accounts, there are no fees for getting out, which you might say is a good thing. And usually it is a good thing. But by the same token, that means if someone panics, they can panic and take their money out. So if you've had someone who invested $100,000 in February, and then March comes along and their account's worth $65,000, we know they should buy and hold. But let's say they panicked and then they took the loss. It's not the robo-advisor's fault, but the person using the technology took a big loss. And I think we're going to see that as time goes on. There's going to be people using it sensibly, but there's also going to be people who are just going to panic sell.
Yeah. So there's no barrier to exit there, is what you're saying, is part of the problem.
It's not part of the problem for people who are using it as a long-term buy and hold. Like
Yeah, I'm
Naresh
talking
was
about
saying,
the people who got out in March. There wasn't really a barrier to exit for them. So
yeah, absolutely. And also, of course, they make it as easy, which again is great. It's not like the traditional banks that would essentially, very conveniently make it hard to withdraw your money or something like that. Oh, just fill out this form, sir, right? So it is 80% good that they make it easy for you to withdraw your money. But bear in mind, the evidence shows, and Jack Bogle, the kind of the father of buy and hold long-term investing, said, don't look at your account until you're 65. And basically, you'll need a cardiologist because you'll be so shocked about how high the valuation will be. I actually think 24-hour-a-day online valuations cause more harm than they solve. But let's face it, nobody can get away with saying to their customers these days, look, just don't look at your account.
Yeah, definitely.
You could say that.
So what do you think? I mean, by this point, everybody's heard the phrase, buy when there's blood in the street, be fearful when others are greedy and be greedy when others are fearful. And I mean, it seems like the easiest thing in the world to understand, but it is so hard for the majority of people to actually do. Because I mean, you saw like the financial crisis, the markets tanked and everybody sold and got out of it. At the beginning of the pandemic, so many people sold and got out because they were fearful. Why is it so hard, do you think, even after people have been hearing this for years, for people to actually stick with it? Like, what is it that keeps people doing that?
I don't know. Humans are a very curious species, right? Because we kind of see ourselves as kind of, intellectually at the top of the tree, but actually human nature is much more emotional than rational. And nobody is completely immune from that. Like, I'm sure me, you, everyone in the world, human nature is human nature. And you're always fighting with those kind of demons in your head. I think one thing, though, is the media really don't help at all, right? Because the media's job is not to educate people, it's to get bums on seats, right? If I'm an executive for even quality, like so-called quality, like some of the biggest in the world, BBC, CNN, whatever, my job is to get people to watch. My job is not to kind of give well-rounded analysis, calm, sensible analysis. So the media always come out with these sensationalist, ludicrous things that this time is different. I think John Templeton said basically the four most dangerous words in investing are this time is different. And it always happens. It happened in 9/11. I'm sure in 1941 when Hitler was going through Europe, people thought this is completely different. And of course, every time is a bit different, right? The lockdown was different to 9/11, was different to, say, 1941, which was different to the Cuban Missile Crisis, whatever. But I just think that people are taken in by stories very easily. That's one reason. It's human nature also, loss aversion. So a loss is more painful than a gain is pleasurable. So even some PhDs in portfolio theory haven't followed their own portfolio analysis. And, in other words, they haven't practiced what they preached. Almost like a fat doctor or a doctor who smokes. Even some PhDs in portfolio theory themselves have panicked, even though they know rationally they shouldn't do it. So I think good investing isn't difficult per se, but it goes against human nature. So I would be willing to bet you that even some people who have worked the Vanguard and those companies that preach buy and hold long-term investing, they wouldn't have been able to actually just keep to it for, say, 20, 30, 40 years. So a few of my clients almost panicked in March, but I kept 100% of my clients in March, which I'm happy about. And when people say to me, well, okay, well, value added, what can you bring? I often mention to them, well, during March, I lost nobody, right? And that's actually quite a thing when you consider how fearful people were for 2 or 3 weeks. I think that's where an investment advisor can bring more value added than they think. A lot of advisors think it's all about technical knowledge, but I think emotional support and just keeping people calm, it's a huge benefit, right? Because those people who invested more in March, I think none of them are unhappy now, right?
Yeah, because you've got the whole, people need to remember that you don't actually lose money until you sell.
Absolutely. A decline and a loss is not the same thing, right? So it's just emotionally seeing that, their money go down. I don't know what you guys saw in March, but I guess the US, just like any other country, a lot of your friends and family as well were saying to you, you should get out of the market. This time is different. I'm guessing.
Yeah,
Did you guys hear that?
Yeah, I mean, I saw everybody being fearful. I couldn't even tell you what my stock accounts were. I'm kind of along the lines of Naresh. I check in every so often because one of the things I would like for you to talk about is rebalancing your portfolio. Kind of a lot of people, if you set it and forget it, you're still getting dividends from your index fund. How often should people go in and reinvest and do all of the rebalancing, especially if you're going across like emerging markets? First off, what kind of markets are you seeing that are the most investor friendly, maybe in terms of protecting your assets? And then also kind of how much of a portfolio diversification are you kind of advocating right now?
Well, here's the thing, and if someone's young enough, actually, if someone literally went 100% in stock indexes and didn't actually have bonds at all until they were like 50, and then gradually increase until retirement, they would actually beat somebody who had a more diversified portfolio in most time periods when analysis has been done. But again, this comes back to what we were talking about before, that obviously 100% stock index portfolio is going to be much more volatile. And if people can't deal with that volatility, then they're probably going to do something stupid, right? They're going to kind of panic sell. And of course, indexes have lost decades as well. Look at even the US markets, which have done well historically. 2010 was a lost decade, 2000 until 2010, those 10 years. Someone who invested that kind of lump sum in 2000 would have been about even by 2010. So, but to answer your question, I think emerging markets should be kept to 10%. I mean, right now, emerging markets are trading at a discount because emerging markets have done much worse than other markets. So I do think there is room for emerging markets. But the US and some other developed markets have actually beaten emerging markets long term because there's actually no correlation at all between GDP growth and stock market performance. Just look at China. It's had the worst or one of the worst performing stock markets now for the last 15 years, right? And apparently the economies have done quite well. So I would say in terms of investor protections, though, most of the main markets are fine. So regardless whether you're talking about onshore US, offshore US like Puerto Rico, whether you're talking about UK, offshore UK for expats, Isle of Man, whatever, most of the main markets now have decent investor protections. I think in terms of diversification, though, being like 90-10, 90 in indexes, 10 in bonds is fine when you're young. But I think for most people, when they get to 40 or 50, it's good to have at least 30 or 35% bonds. A lot of people thought 60-40 was dead. The 40% in bonds was too conservative these days. But I think what's happened this year has shown that if you're close to retirement, bonds still have their part to play. But it also depends on how people can deal with volatility as well, right?
Yeah, and just for a quick update, I am up 16% on my Wealthfront account, and I opened this up 3.5 years ago. So not bad considering that we did see a major downturn this year in 2020. And I really opened up this account just for fun. It was just to try out the robo-advisor, so I didn't put a ton of money in there. But I'll tell you my strategy when it comes to invest, because you brought up the point that the best investors are dead people. And I know I've seen short videos about man versus monkey and how monkeys have invested better than man has. And I think just through experience, I've actually lost a lot of money in different investments, including stocks, like triple levered ETFs, options trades, you name it. I spent my 20s just kind of, I view it as kind of like an education. Like losing that money was like paying tuition for getting that in. Yeah, I wouldn't call it the lost decade. So a lost decade.
The lost financial decade. How about that?
The lost financial decade. The lost financial.
Yeah. We've all done that, or most of us.
And the important thing is that you learn from it and you don't keep making the same mistakes. And I hear stories all the time of people who don't learn from their mistakes and keep doing it in their 30s and 40s and 50s, and they can't retire. And there's been a recent story about a kid on Robinhood who apparently was a glitch on Robinhood that showed that he lost like $700,000 in options trades, and he didn't know it was a glitch. He thought he was in the whole 700,000, so he ended up committing suicide. And I think he was like 23 years old. He was in his really earlier, it was like in his earlier mid-20s. I think it was early 20s. And the point that I'm making, the three kind of what I learned, and I wrote this down. I shared this with my wife. I'm going to share this as my kids get older. But when it comes to investing, there are 3 areas that I've learned that just work out. Number 1, if you're going to invest in stocks, I have created what's called a forever portfolio. And the forever portfolio consists of stocks that you basically either wait for some kind of downturn, because there's always going to be some kind of a correction or a downturn, and you buy these stocks and you hold them forever. Or if you want to invest today, you just go ahead and buy them today and you hold them forever if you're really kind of looking to put your money somewhere. And these are very large, blue chip, high dividend companies that are not going anywhere during our lifetimes, and that haven't gone anywhere during our lifetimes. When I say gone anywhere, I mean they've only gone up. They haven't gone down. Their brands are just difficult to compete with. These are companies like Microsoft, Google, McDonald's, Coca-Cola, Procter & Gamble, Philip Morris, Altria Group, etc. And so I have a list of, I want to say, like 15 to 20 of these, probably like 15 of them. And they pay really high dividends. And look, you're not trying to hit a home run. They're not going to double within 5 years. They're not going to go from, $100 to $1,000 quickly. There are some stocks that do that, but these aren't them. And so I learned through experience, because when I was in my 20s, I was going for the penny stock that could go up 10,000% in 1 month. And yeah, that's how you get your ass handed to you and lose a lot of money. And so I said, you know what? I'm okay with the dividends. I'm okay with making 6% a quarter, 7% a quarter in dividends. And then on top of that, if I get 2% appreciation or 5% appreciation, I'm okay with that too. So that's what I learned when it comes to the forever portfolio. The other 2 areas that I made note of, number 2, residential real estate. Seeing the pandemic right now, people are the value, or not the numerical value, but the value of a home has gone up because we spend so much more time now at home.
Oh, really?
And
in the US, it's gone up.
Oh, yeah. Well, when I say not the numerical value, I just mean people being locked down in their homes. They're now all of a sudden using their home more for the kids, for the home office, for everything. The home is now the center of life in the United States. And I think this cultural phenomena is only going to continue because, according to various research studies, it takes about 21 days for a new culture to be adapted. Well, we're already 4.5 months into this lockdown pandemic. And so I think the culture has definitely changed in the corporate world and in the personal space. And on top of that, residential real estate, everybody needs a place to live. And the tax benefits here in the United States, I'm not sure how it is across the world, but the tax benefits, all that mortgage interest, you can deduct. Various other things on your properties, you can deduct. So it comes with cash flow, but it also comes with tax benefits. And then the third thing, which not a lot of people know about, which I like a lot, is whole life insurance. I'm not sure if you're too familiar with whole life insurance, Adam, Fayed, but here in the United States, whole life, the only thing we know for sure in life, or 2 things we know. We know taxes, and we know that we're going to die. We don't know when we're going to die, but we know it's I'm sorry to break the news, but I will die someday.
World mortality rate holds steady at 100%, as the Onion says.
We need new technology for that.
So knowing this, and knowing this, it's like a no-brainer. Okay, I should if I'm 100% sure that I'm gonna die, I should probably get some type of life insurance that's gonna protect future generations. And in the case of whole life insurance, it's almost like an investment because you have a guaranteed payout. So, like, I just opened up a couple of policies for my wife and me at the end of last year. Thankfully, at the end of last year and not right now, because they have completely shifted their models and the rates have gone down. But it's 4.5% guaranteed return every year. It says on the contract That's what the company guarantees. You buy the whole life insurance and you will get 4.5% guaranteed. And then if they pay a dividend on top of that, which most of them do, you could end up making 6 to 10% on a good year off the whole life insurance policy. And the only risk you're taking on is if the life insurance company goes bankrupt, which the company we bought it from, they've been around since 1865. So they've survived every depression, every recession, pretty much known to the United States. So these three kind of personal finance tips, my forever portfolio, the residential real estate investing, and whole life insurance, none of them are get rich quick. You're not going to get whole life, you really see the fruits of your labor at retirement, or your kids or grandchildren see it after you die. So none of these are get rich quick. None of these, they're kind of safe, long-term financial planning that I've learned from my 20s through all the mistakes that I've made.
Well, it's interesting you say that, because when it comes to whole of life, actually, there's nothing wrong with it per se. But one thing I would say, though, is people should, though, probably compare term and just investing on the side, right? When it comes to whole of life, there's good calculators for it now online. I'm sure that there's quite a lot, because obviously there's different rates when it comes to whole of life, and you can compare it to having, say, a 30-year term or 20-year term if you have kids. So you can do a comparison. But yeah, I think when people have kids, some kind of insurance makes sense, whether they go for the whole of life option or term insurance because it's cheaper, but then it's dead money if nothing happens. It's interesting what you said about real estate. I think the US, system is similar to what happened in the UK, but the UK has changed a little bit now. Basically, property used to be quite tax efficient in the UK, but the government has subsequently changed that. So the UK government now, they highly tax property, and that wasn't always the case before. So to give you an idea, in the UK, to buy a property, it costs between 0 to 15% upfront, depending on how luxurious the property is. So let's say you're a second home buyer and you buy £1 million house, that's going to cost you £150,000. And then in addition to that, you have capital gains tax, ongoing tax. But what you're saying, and I've heard it many times as well, the US has a pretty good system from the point of view of people who are buy-to-let, essentially. And the UK used to be like that. In the 90s, 2000s, you didn't have to be a professional landlord to make a lot of money in buy-to-let. There were doctors, teachers, people who knew they weren't experts in this area, who just had a stable job, had 2, 3, 4, 5 homes, and they made quite good money. But now the government has really changed their policy quite a lot when it comes to that kind of thing and taxes. Hopefully it doesn't go the same way in the US, but maybe you guys would protest if that happened. Especially in Texas, right, maybe. Although Texas has high taxes, I heard, on property.
Yeah, we do have really high taxes on property here. How have you competed, against the big companies? You as a personal solopreneur, I don't know if you have any official employees with you, or if you just kind of have virtual assistants or what, but how have you competed against the Schwabs and the Vanguards and the Fidelity? How do you position yourself? Is it just the human touch, or how do you compare yourself to them when you're picking up new clients and convincing them?
I would say it's the online strategy. First of all, I am a company owner. I co-own a company with my business partner, but we've got 20 or 30 people, which obviously is small compared to some of those companies you're mentioning. So actually most or almost all the clients that come to me, it's because of the online presence. So often they see me from my website, or indeed on Quora, where I'm one of the most read writers now worldwide. So for a certain percentage of people, they want that personal touch. It's a bit like, I think it really started in the 80s with the likes of Kiyosaki, and for all of his faults, Trump, whatever you think about him, he saw the whole kind of personal touch and how it was going. I think really that's the key, right? People want to buy into somebody that they can trust. So I've noticed that people who come to me directly, it's always much easier than people who, for example, come from the company website. Because let's face it, no matter if my company has 15, 20, 25, 50, it's never going to be Vanguard. Whereas in comparison, when it comes to say, I don't know how many views I have on Quora or something like that, that's something where I can compete and say, well, look, I'm the most viewed writer anywhere in the world on Quora. I get about 40 million answer views a month there, and people buy into that personal story. I don't think it makes sense to compete on fields that you can't compete on. And also linked to that, I think expat specific advice, a lot of people can't get that portable advice. So they want to do things like set up low cost Vanguard ETFs and other things, and they want it to be online with someone they can trust, but they can't often go to, say, Vanguard. In the UK, they can. In the US, they can't. They can as well. But let's say they're, I don't know, a British person who's on a 2-year, expat posting to Angola. Their options are much less. And even US people, if they're overseas as expats, it's much more difficult for them to get good options. A lot of US brokerages close down Americans' account if they move outside of America. So portable advice is a key thing, as alongside the personal touch, really.
So when you first got started, though, I mean, pretty much anybody who's going to go into business right now, you're not creating your own market for the most part. You're going into an established market and starting to compete against companies who are there. How did you, whenever you first started on Quora, for example, you were just some rando posting articles. How did you continue to position yourself and establish yourself to the point where you could become a voice that was trusted and heard and people could rely on to manage their money? Because not meeting somebody and convincing them to give you their savings is not something you're just going to be like, hey, this guy has 0 reviews on this site, I'll trust them.
Yeah. Well, I think what helped is I did the traditional side for many years before I went online. So I did have those early years where things were much tougher, when everyone's starting in a new industry. So I already had my clients before going the whole online route, right? I didn't need to onboard new clients because I had old clients anyway. So then to answer your question on Quora, I played the long game. When I came on Quora, it all happened organically. I actually started as a reader, and I just occasionally read things, and occasionally I wrote things, and I didn't ever plan for it to become so big. But then what I did is a combination of consistency. I kept doing 20, 30, 40 answers every single day, but also not suggesting get rich quick, giving very sensible advice and kind of building it up. That made sense, right? I never, ever came into it thinking, right, I want to get a client in the first 3 months or first 6 months. If it happened, it happened, but I never came into it like that. I always saw the medium to long term. And the same thing with anything I do, whether it's YouTube, whatever. Yes, being impatient, as long as you're persistent, can actually work. But by the same token, you also have to look at the bigger picture, the medium term, the long term. I think things like online reviews have helped, like LinkedIn and whatever. But also, I think part of it is just getting known, right? Because a lot of people, they intellectualize in business, but they forget most people's problem is not being known at all, right? If you're obscure and you're only known in your local community, even if you've got glowing reviews in your local village of 200 people, yes, that might be enough for you to kind of sustain a little bit of a livelihood. But most people's problem is not being known. If you get known by enough people, there's always going to be a minority of people who are going to love what you do to the extent they're going to want to become your client, right? And I'm sure it's the same in any industry, right? If you're, I don't know, a lawyer who's specializing in, I don't know, the expat niche for overseas Americans, you're probably not going to get much traction if only 1,000 people are reading your online content every month. But if you're getting millions, I'm sure you're not going to have to put round pegs in square holes, right? Because you've got so much volume there. So I think that's another key thing, not trying to put round pegs in square holes, playing the long game, getting kind of, I wouldn't say famous, because obviously online's never the same as offline. It's not like if you get millions of readers online, you're going to be like David Beckham or something and people are going to notice you're in the airport. But you know what I mean? If you're known, there's always going to be a certain percentage of people who you catch them at the right time. They think, this is exactly the guy I was looking for. He's got credibility. But that takes time to build up. I would say that takes at least 6 to 12 months.
Well, talking about being known, that is for, like you said, any industry. And I think President Trump in the United States is a prime example of that. He's somebody who didn't have any political background, but he had the brand name and he had the money. And I think in any industry, whether it's politics, like you said, law, finance, marketing, you're just at a major advantage when you have that brand. When people already know you, you can pretty much sell them whatever you want. You can. I make a joke that I used to work. I don't know if you've heard of Porter Stansberry, but I used to work for Porter Stansberry, and he has such a huge like niche following of millions and millions of people worldwide, and he could literally sell a bag of shit and people will buy it because he's Porter Stansberry. That's just how I can walk around with a bag of shit and people will think I'm crazy. But if you're Donald Trump or Porter Stansberry, people will buy it. They'll do whatever you tell them to do. And so that's just so, it goes to the power of marketing and how promoters and marketers can become, successful in their business or whatever product that they want to sell. But it also ties into, I think you brought up, following like a guru, like following an expert. I think that's one of the best things you can do. Find someone who aligns with your views, with your philosophies, and like subscribe to their free newsletter or buy their book on Amazon. They all have books, they all have courses, they all have podcasts. You don't even need to buy the book. There's a lot of free stuff available. And just read them in and out and tap into their mind, see how they do things. And that's how kind of I got started in not just investing or finance, but in a lot of different areas by subscribing to that free newsletter. And Robert Kiyosaki was one of those people. I read Rich Dad Poor Dad, I think was, so my business exposure as a high schooler was limited. The only two tools that I was exposed to as a high schooler was Rich Dad Poor Dad, the book by Robert Kiyosaki, and The Apprentice, Donald Trump. And watching The Apprentice and taking a course. My high school actually had a course on The Apprentice, and that introduced me to the book, The Art of the Deal. And that's it. That was the extent of my high school business education. But talking about
U.S. education system.
and talking about my so those are my two introductions. And talking about residential real estate, it came from, I keep going back and referencing Rich Dad Poor Dad, because the principles I have talked about here that I continue to think about, all in the book Rich Dad Poor Dad. I couldn't really understand it much as a high schooler, but it all made sense in the book as a high schooler. I was like, I don't understand what he's saying. I don't understand these terms. Like, this is all beyond my head. And now I go back and I don't even have to read again. I think about it. I'm like, oh, that's what he meant by those quadrants. That's what he meant by cash flow. That's what he meant by the tax breaks and deductions. It's almost like I was reading the book again in my mind, even though I didn't understand 80% of it when I was reading it as a high school student.
Yeah, it's interesting. And I think also it's a case that these days people are much more skeptical about corporates in terms of, yes, it depends on the person, and it depends on where you're living. As a broad generalization, in emerging markets or even smaller towns, and I'm sure it's similar in the US, you still have more traditional people who want to go to the bank, meet someone face to face, have the big brand name or whatever. But in general, a lot of people now are skeptical about that one size fits all corporate. They like either the upstarts, the likes of Betterment, or the guys trying to kind of knock the people off their perch, or they want to deal with someone like a person and not dealing with a corporation. It's a bit like me, right? When I tried to set up my company, what did I do? I bought into the person. I can't even remember the name of the company that incorporated my company off the top of my head, but I can remember very clearly the person I dealt with, what he looks like, and so on. And I think it's the case when it comes to especially people who are maybe, for example, a little bit wealthier, or they're an expat, or they have some kind of real specific need. A lot of them are not looking for that kind of HSBC kind of one size fits all big brand. That's kind of very 1980s, right, in a way, like the flash office, the suits, the ties, saying, well, we are this, we're the biggest company in this, whatever. I think people have become more skeptical about that. And also, as you said earlier on, technology makes people feel a little bit more, in some ways, I wouldn't say safe, but also less pushed. Because if you think about it, if I'm dealing with people remotely, it's much easier to ignore my email if you ever don't want to deal with me, or ignore my WhatsApp message. But if you're face to face with someone, it can be a very awkward experience for a lot of people. It's a bit like when we go to the airport. Let's be honest. If we go through the humanless section of the airport, where it's just an e-gate, I don't know, I think you guys might have it in JFK or the big airports in the US. We did it to come to London, and it's much nicer than speaking to a human, kind of interrogating you, saying, how long are you coming to the United States, sir, or France, or whatever? Why are you here? Or where's your ticket to get out? Technology makes you feel more relaxed in some ways, right? It doesn't interrogate you. And I think human advisors who aren't afraid of technology, but they personalize themselves using technology, that can be quite good because it still doesn't feel as pushy. Whereas going to meet somebody, not only does it take more time, but it's kind of a pushy encounter as well, or it could become a pushy encounter, right? When we do business, probably the last thing we want to do is meet someone face to face unless we trust them a lot, because we're going to assume they're going to push us, right?
Yeah, absolutely. So if somebody's coming out and starting their retirement funds on their own, and I know you don't deal specifically with U.S. investors right now, like you mentioned earlier, I don't know if the things like Roth IRAs and traditional IRAs are a thing in other countries, but what kind of accounts are you helping people set up mostly? Is it pre-tax money? Is it post-tax money? Kind of what are the accounts that people should be looking at potentially using to start off with their retirement savings?
So if we separate people living in the US now to overseas, so for the people in the US, in general, those kind of tax-deferred accounts where they're linked to low-cost indexes can be some of the best ways of doing it. But as I mentioned earlier in the show, by the same token, we always have to remember that a very expensive traditional IRA account, despite the tax benefits, will usually lag a slightly less tax-efficient account, which is linked to, say, the indexes. So tax efficiency is important, but it's not the be-all and end-all, right? So I think for US people, those kind of tax-deferred accounts can be good, depending on the situation. For expats living overseas, if they're not American, again, tax can be an issue, but it's more the case of, let's say you've got a British person living in Dubai, as an example, UAE, it's a 0% tax country and it's a 0% capital gains country. So in which case, if you invest in a 0% capital gains environment, like, for example, British overseas territory, or anywhere like Puerto Rico even, it's a US territory, but it's pretty much got 0% tax on overseas investors in most situations. That makes a lot more sense than sending money home, because what's happening now is a lot of tax authorities around the world are saying to expats, look, if you keep sending money home, we're going to do a so-called ties test. So what the UK government does is they say to people, the more ties you have to the UK, so in other words, businesses, property, investment accounts, we might consider you tax resident in the UK, even if you're an expat. I know Americans, even if you move overseas, you still have to pay tax sometimes to the US. You still have to report, and above a certain threshold, you have to pay because you've got a citizenship-based taxation system, right? So you can't get away from Uncle Sam completely unless you renounce. So it's different for Americans living overseas. But to answer your question, I think for Americans in particular, those tax-deferred accounts have a lot of benefit, especially if the employer is doing half as well. But if you're an entrepreneur, some of those self-directed accounts can be good, but again, as long as you kind of can bridge that kind of behavior gap and you can just stay the course and all the things we talked about before, right? What's your take on this kind of thing? Because a lot of people think there isn't a big difference between some of these accounts. It's a lot about technicalities. Do you think it's a big thing for US investors who are local in the US, which kind of account they open up, or do you think investor behavior is more key?
Well, we've been going for about an hour now, so let's take a break for just a minute and give people a chance to come back on Wednesday to hear more about this. We have been talking with Adam Fayed, the founder of global online financial advisory firm. You can check him out at adamfayed.com. That's ADAMFAYED.com. You can also check him out on YouTube. Go there and search for Adam Fayed. You can also find us at workfromhomeshow.com. That's workfromhomeshow.com. send us an email with any questions that you have, either for us or for Adam Fayed. You can email us at hello@workfromhomeshow. That's hello@workfromhomeshow.com. Also, go to your podcast platform, write a review for us, take a screenshot, email it to hello@workfromhomeshow.com, and we'll send you some free goodies. And until next time, keep on working from home.